Thank you, and over to you, sir.
Yeah, thanks, Stephen. Hi, everyone. It's a pleasure to host Radico for their Q3 results call. From the management, we have Mr. Abhishek Khaitan, Managing Director, Mr. Dilip Panthia, Chief Financial Officer, Mr. Amar Sinha, Chief Operating Officer, and Mr. Sanjeev Panga, President, International Business. I'll now hand over the call to Abhishek for his opening remarks, and then post that we can start with the Q&A session. Over to you, Abhishek.
Thank you. Good afternoon, ladies and gentlemen. Thank you for joining us on our third quarter FY22 results conference call. I hope you are all doing well and keeping safe. For most part of the Q3 FY22, market conditions remained normal as the previous wave of pandemic subsided. We are very pleased with our volume growth, particularly in the prestige and above brands, which grew by 18% over Q3 FY21. We have continued to outperform the industry with the total volumes of 6.98 million cases, which is a 7.4% year-on-year growth versus industry growth of 2%. The growth was broad-based across the portfolio and across states. After a strong start with the launch in UP and Maharashtra, Royal Ranthambore Whiskey and Magic Moment Dazzle Vodka have now been rolled out in 3 more states. Both these brands have received extremely positive response. In the month of December 2021, 8 p.m. premium black whiskey crossed a monthly run rate of 2 lakh cases and 8 p.m. family crossed 11 lakh cases. This truly reflects the strong consumer franchise that our brands enjoy. In January 2022, we have dispatched the first order to CSD for Rampur Indian Single Malt and Jaisalmer Indian Craft Gin. These brands will go on to create a strong positioning for themselves in the CSD market in the coming period. With the investment in Rampur Indian Single Malt capacity expansion few years back, we will see substantial quantities of the single malt becoming available for domestic as well as export market. During the quarter, exports have been impacted due to global freight scenario and non-availability of containers. However, the order pipeline remains strong. Over the last few quarters, we have seen an inflationary trend across industries, and our sector is no exception. We have seen a sharp increase in some of the key input materials, which has impacted our profitability margins, particularly in the non-IMFL segment. In the near term, the operating environment is expected to remain challenging. In the medium to long term, we are confident of achieving the high teens margin that we had guided earlier given the portfolio premiumization and backward integration. I'm very excited to share that after consolidating the business over the years, we have embarked upon a judicious capex plan. We have been evaluating return accretive capital allocation opportunities. Today, we have a very strong balance sheet and free cash flow generation. Since FY 2016, we have reduced our net debt from the peak of rupees 950 crores to rupees 135 crores currently, all through internal accruals. During this period, our IMFL volumes have expanded from 18.2 million in FY16 to around 26 million cases. Our current capacity in Rampur is fully utilized, which necessitates a need for expansion. This will be funded 50% through internal accrual and rest from borrowing. All the capex will be completed by Q1 FY24 and cash flow will start accruing. We will see our debt levels peak out in FY23 and then start to reduce again in FY24 onwards with the strong cash flow generation from the existing business as well as these new projects. We expect to be debt-free again by FY 2025. Both these projects will be accretive to EPS and cash flows from the inception. The business growth opportunities of the Indian alcohol industry is very compelling, and UP is going to be one of the key growth engines. Given the current raw material scenario due to the ethanol blending program of the central government, molasses availability will be restrained in the future. The premium IMFL industry is growing at a faster pace than the overall IMFL industry, which uses grain-based alcohol. Therefore, the demand for grain ENA is going to increase further. One of the key reasons that we have been able to create brands like Magic Moments, Morpheus, 8 PM Premium Black, Jaisalmer, and Rampur Indian Single Malt is because we had quality alcohol from our own plants. The recent change in Uttar Pradesh state excise policy of mandating grain alcohol 42.8 degree category, which comprises 25% of the industry, is an important step towards moving consumer to higher quality alcohol. With own ENA from Rampur dual field, which will become operational by Q4 FY23, profitability of the country liquor segment will also improve. These projects will enable us to expand our in-house capabilities to drive future growth of the branded business and capitalize on the industry growth opportunities along with securing raw material supplies. In Sitapur, we are also putting up malt maturation facilities, keeping in view the future growth potential of Rampur Indian Single Malt. We are also setting up a craft gin plant to support the growth of Jaisalmer Indian craft gin. Both these projects will be return accretive with the average ROC in the range of 20 to 23% and payback period of 3.5 to 4 years. It will create value for all stakeholders. We have 28 contract bottling units and we are currently buying 50 lakh liters of ENA monthly, so this capex will secure the large captive requirement. Rampur dual field project will be operational by Q4 FY23. All major plants and equipment have been ordered. We have acquired over 107 acres of land in Sitapur and the development work will start shortly for the greenfield. For the purpose of acquiring land, we have formed 7 step-down subsidiaries as there is ceiling limit on the acquisition of the land in UP. The Sitapur plant will be operational by Q1 of FY24. We are very happy with these developments as these capacities will pave the way for us to capitalize on the future growth opportunities presented by the Indian IMFL industry and in particular in the state of Uttar Pradesh. I would now like to hand over the call to our CFO for a detailed operational and financial review. Thank you everyone and over to you, Dilip.
Thank you, Abhishek. Thank you everyone for joining us on this call today. During the third quarter, we have reported IMFL sales volume of 6.98 million cases, representing an increase of 7.4% on YOY basis. This was led by Prestige and above category volume growth of 18.2%. In value terms, Prestige and above category registered 21.5% growth. Prestige and above category account for 33.8% of total IMFL volume compared to 30.7% in Q3 of FY21. Net revenue from operation during Q3 of FY22 was 766 crores, representing an increase of 12% compared to Q3 of FY21. During this period, IMFL sales value increased by 12.5% as a percentage of total revenue. IMFL sales account for 82.1% of net revenue compared to 81.7% in Q3 of last year. Gross margin during the quarter was 46.2%. This was impacted due to the ongoing commodity inflation, particularly in non-IMFL business. Over the last few quarters, we have seen prices of fat resin and other packaging material go up significantly. However, on Q-on-Q basis, gross margin has remained stable. Despite significant increase in raw material prices, gross margins for the IMFL business was impacted only moderately owing to a favorable product mix. ENA price have increased marginally in line with expectation given the recent changes in ethanol prices. Raw material inflationary trend is expected to continue, although the rate of increase is expected to moderate in Q4. The company is taking all efforts to optimize costs and to mitigate any margin headwinds. Over the long term, we expect to continue our margin expansionary trajectory given our portfolio premiumization. Finance costs decreased by 48% on YOY basis from 5.39 crores to 3.12 crores during Q3 of FY22. Company's cost of borrowing is one of the lowest in industry due to the lower interest environment, stable profitability, strong capital structure, and improved liquidity position. We have been an efficient working capital management and a very strong credit controls. During the first 9 months of the year, we reduced our net debt by 62 crores after a capex of 24 crores on new projects. The recently initiated capex plan will enable us to be future ready and capitalize on the industry growth opportunities. We have a very strong financial position, comfortable liquidity. During these times, we are taking all necessary steps to sustain our financial strength, maintain robust business model, and grow consistently, competitively, and profitably. With this, we will now open the line for Q&A. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Avnish Roy from Edelweiss. Please go ahead.
Yeah, thanks and congrats on good set of numbers. My first question is on P&A volume. That's up 310 bits as a percentage of IMFL for you. So what will be your long-term 3 years, 5 years target here? Is there a conscious strategy or is it that both segments will have their own growth rate? So P&A will keep increasing, but do you have a conscious target in mind?
So, see, currently P&A is at the level of 33.8% of the total sales. But as you would have seen, our thrust in the last 3 years particularly has been very aggressively on the P&A segment. We have been promoting all our premium brands. Magic has been growing. Morpheus Super Premium Brandy has been growing. 1965 Rum has achieved 10% market share in defense and has garnered equal traction in the civil market. And now we have launched our most favorite segment premium brand called Royal Ranthambore, which has just hit 5 states. We were seeing excellent traction on these products. We have upgraded Magic Moments Vodka to the next level, which is close to some of the premium international brands. This has also received very good response. Verve in Magic Moments has achieved a 20% market share amongst all premium brands, including Indian and international. Now, what we see here from is that these brands have just hit the market, like Royal Ranthambore and Magic Dazzle. They will become stronger and stronger. The next 3 years are going to be quite eventful because any premium brand requires at least 3 years of right marketing dosage for the brand to bloom. Coupled with that, our focus on premiumization will continue, like we had mentioned in the last, earnings call. We had 2 whiskies in the pipeline. One has been delivered. The another premium whiskey will be delivered over the course of the year. So let me say that we are well on line with strengthening the premiumization and the P&A segment stronger and stronger. The next 3 years are going to be quite eventful for Radico.
Okay, thanks. My second question is on the raw material and GM. So we are seeing general inflation everywhere. So ENA, glass bottles, corrugated box, diesel for logistics, everything has been inflationary. So how you have managed QOQ stable GM? Is it because of mix? And second, in Q4, do you expect things to be even more challenging versus Q3 in terms of these raw materials?
So you are right, Abneesh, that we have seen this inflationary pressure in this current year in last 9 months. And ENA, we have seen that 2.5% YOY as well as Q-on-Q price increases. We see that the trend now should moderate because the impact of the supply side constraint which has been there is now being addressed slowly, and I think next year onward we should not see that. Rather, some of the prices in the paper box and all that, or PAT, etc. But we will be happy with these prices even because we are trying to upgrade our portfolio, improve the product mix, and in IMFL segment, as I said in my remark, that the impact of the inflationary have been very, very moderate because of the product premiumization. Simultaneously, this will next year be passed on by taking some price increases in couple of large states, which the industry is already in touch and deliberating with the state government. Representation has been given. So as and when it happens, that will also be known to the industry. So I think next year onward, the price pressure which we have seen in this current quarter, and particularly on gross margins, should be done away with, and I think we will be again on a better trajectory on gross margin and EBITDA margin.
Sure. One last follow-up.
Sorry to interrupt, but for any follow-up, may we request you to rejoin.
Okay, I'll come back. Thank you.
Thank you. Before we take the next question, a reminder to the participants, please limit your questions to 2 per participant. For any follow-up, may we request you to rejoin the queue. The next question is from the line of Jignesh Kamani from GMO & Company. Please go ahead.
Yeah, hi. Just want to know what is the current requirement for the ENA, and since we are doubling our capacity from 101 million liter to close to around 207 liter, it will suffice to what percentage of the requirement after 2 years down the line? And second thing on the capex front, like in Rampur, we are spending 185 crore just to convert single feed into multiple feed. It will be only incrementally just 7% more new, where we are spending 555 crore. So just want to check what will be ROC and payback on the dual feed conversion, whereas we are spending 185 crore.
So as far as the ENA capacity is concerned, we have around 10.5 crore liter in Rampur. However, this is for our brand business as well as for country liquor, both put together, which is now utilized 95%. And as we are doing around 26 million cases of the IMFL, so that is also another 10-11 crores liter, and there is a country liquor portfolio also in state of UP. So put together, these will be utilized as the industry is growing double digit, and particularly in Uttar Pradesh, the industry growth continues to be in double digit. We expect in next 3 to 5 years, the industry will have current year itself without an increase in the prices. The state is talking about 40,000 crores of revenue from Alcobev industry. So we see a great growth, and in due course of time, this capacity expansion which is being done will be utilized fully for our branded business. So keeping in view the horizon of 3 to 5 years, and as the government ethanol blending program, the molasses is being diverted more and more into the ethanol, and we have seen yesterday again the government data that the molasses, the alcohol, the ethanol blending has gone from 8% to 11%. Keeping the raw material security into account, this is our plan for 3 to 5 years to make this happen. And as we are moving towards premiumizing, and almost all the products uses the grain-based alcohol for the premium product, so this will be well utilized. Second point is regarding what was. Yeah, right. So on dual feed, I will say that our molasses plant, which is a capacity of 140 KLPD right now, and to convert into dual feed, it is a balancing of equipment also, and putting all the equipment which are required, necessary for looking at the future from efficiency, productivity point of view. We are also adding one dryer for the DDGS. So all put together, this will be there, and the this is having a payback period of 4.5 years. So that is also justified looking into the business requirement.
See, why we are converting the dual facility is for a simple reason. We foresee that in the near future, all the molasses products will convert into grain, which means that the entire portfolio, even of the non-IMFL business, is going to get premiumized into economy brands like what is in the southern states, where your recoveries are much higher. So converting into the dual mode will help us to increase our margins, which you will see from Q1 of 23 coming into play. And going forward, once the entire non-IMFL business is converted into grain, the recoveries and the margins will increase substantially.
So, but our, like, in terms of volume will increase by just 7% when we convert into dual feed. Will our cost of manufacturing of ENA will reduce drastically from molasses to converting to grain?
No, the selling price will increase because, like, in the 25% what the Uttar Pradesh government has given, the grain product selling price is much higher.
I'm talking more from the manufacturing cost, because ENA via granulate is also available in future, right? Because there will be enough capacity available for the both molasses and the grain base because of the expansion happening in the industry. So I'm saying, when we are spending 185 crore just to convert from molasses to grain, and it is not reducing any, you can say, our manufacturing cost. So from the ROC point of view, we are not getting much. Understand the realization part, but that will be more from the selling point of view, not from the manufacturing point of view.
No, I'll just explain you the scenario. In Uttar Pradesh, where we are into the non-IMFL business, what is happening, the molasses is given by the government at a reserved price. So now with this ethanol blending, that reserve price will eventually go and everything will get converted into grain, where the pricing of the product will become higher. So that is what is going to happen in the next 2 to 3 years. So we have already prepared ourselves, because the whole segment of country liquor, which is close to 80 million cases, will get into economy alcohol.
And how is the availability of grain? Because if you take about, as per the government plan for the ethanol blending alone, they are expecting to have a close to 4 crore worth of, you can say, ethanol from the grain alone. If that is the case, then there will be also issue on this grain availability.
See, in the end, the water will its own balance, and what we feel is, because molasses will go more into ethanol, the pricing of the grain products will go up. So eventually, in the end, your brands will go, because the higher you sell, the domestic brands, the national brands will sell much more. So there we have a huge advantage.
Plus, the UP state government has defined the policy very clearly that all IMFL henceforth will only be grain. So this dual feed conversion is going to benefit us in a very, very big way.
Sure. We'll come in a queue for a follow-up question. Thank you.
Thank you. Next question is from the line of Aaron Armstrong from Ashmore Group. Please go ahead.
Hi, thank you for taking my question. For the new CapEx project, could you talk about how much of that relates to business that you currently outsource and that you're now looking to bring house and insource, versus how much is to support new growth without the change in the kind of insourcing and outsourcing mix? And then perhaps if you could share any details or some examples of where you're currently outsourcing and the new capacity allows you to bring that in-house, and the kind of margin savings, cost savings that you'll see from that.
So presently we have actually been outsourcing around 50 lakhs liter of the ENA for our IMFL business. So across India. At this per month, right? So this is 6 crore of the alcohol ENA being bought by the company. And as far as your question regarding that, how much does it save? So the backward integration actually saves a lot. That is why we are talking about that this project will give a ROCE of 20 to 23% and a payback period of just 3.5 years. So the payback is quite huge, and it will start generating the EPS and free cash flow from the first full year of operation, which is in 23-24. That is the reason we are very, very conscious about our capital allocation, and the reason for allocating for a captive E&A unit is our own requirement will be there. In 3 to 5 years, we will have to have the facilities, and as the ethanol blending program is generating the grain-based alcohol as well as the molasses-based alcohol for the alcohol industry, for us will be a challenge. So we are having our own quality alcohol, which will support our branded business.
Can I add?
Yeah, please.
So just to add, you see the growth of the Indian alcohol business is taking place in double digit in the prestige and upward segments. We are currently sourcing 6 million liters per month out of the additional 100 million liters that the new plant will give, which means 60 million liters is required in any case going forward. So we will have this control on our destiny, because we are basically premiumizing, and all our premium brands require grain which is of good quality. That's what we are planning to do.
That's great, thank you. And perhaps if I could ask, on page 12 of the presentation, you mentioned malt distillation capacity that should start to bear fruit in 2024. Can you talk about how significant this could be? Any indications on volumes that we could expect?
You see, we expanded our malt capacity a couple of years ago. Our malt distillery is based in Rampur itself, and we've been aging and maturing malt for a Rampur Indian single malt all this while. So we are setting up additional maturation facility in the new plant, which will give us rich dividends in the years to come when all this malt is available to us. We do expect a much larger, because currently Rampur is still on allocation, whether it is in the international market or we launched it only in very few markets in India. So it's still on allocation and will remain on allocation for next 12 months. But we expect substantial quantity of malt to be available for bottling from next year onwards, that's basically 23-24 onwards. So that should give a huge boost to our luxury portfolio as well as our revenues.
Would you be able to share any numbers around that, please?
Well, we don't share brand-wise numbers, but, going by the response and the awards that our brands have been winning world over, in fact, Rampur Asava was ranked the number 7 amongst the top 20 whiskies of the year 2021. They've been consistently winning gold medals and ratings of 94, 95 points with all the whiskey experts. So we've just touched the tip of the iceberg, because it still remains in allocation. Our brands are in about 85 countries, but Rampur is only available in about 35 countries. So we have a long way, and we are constrained by the availability of malt. Hopefully that will be over in the next 12 months, so you can see huge growth coming from this portfolio.
Thank you. One final question, if I may, please. So GP margin was around 50% a year ago. We're slightly off that. Is that something you think we could recover in the coming quarters, or do you think that could take slightly longer to get back to?
Yeah, so this is a phase where we are seeing this inflationary pressure, and I think as we have already guided, we expect the margin again, gross profit margin, to again come back on 48 or 50 levels after when this inflationary pressure is over, price increases happen. At the same time, product premiumization is happening. So all these are toward that. So we are expecting this in coming 2 to 3 years, we should be back in our gross margin at 50 level, and on operating margin as guided on high teens level.
That's great. Thank you.
Thank you. The next question is from the line of Amarjit Moria from Angel One. Please go ahead.
Hello, sir. Sir, can you provide me 9 month industry volume numbers and what's your expectation in the full year industry expectation growth number?
Industry volume number.
So 9 months we have actually shown a growth of 18.6%. And the best thing is that the prestige and above brands have grown by 23% against an industry growth of prestige of only about 18%. Regular brands have grown by 17%. Overall, we have seen an 18.6% growth. The growth, therefore, in volume terms is very, very healthy. And we are
14%. Industry 14%.
The industry growth is 14% overall. We have overall grown at 18.6% and we have outsmarted the industry growth as usual for the 5th year.
So, sir, what's your expectations for the full year? If we are considering the 4th quarter for the industry.
For the full year, I think we should 18.6% is our growth, so we should be in the late teens only for the full year.
Yeah. And sir, what about the industry?
Industry would be the same. Industry has grown in the 9 months by 14%, so I think industry would be in the range of about 12 to 15%.
Right.
Okay.
And Radico's growth will be much ahead of the industry.
So we can see the 4 to 5% outperformance against the industry.
Right.
In terms of volume. Okay, sir. Thank you, sir.
Thank you. The next question is from the line of Vishal Chopra from UTI Mutual Fund. Please go ahead.
Yeah, hi everyone. Thanks for taking my question. I'm just going back to this capex we are planning. I mean, hearing you, I understood the problem you are anticipating is that with this blending increasing, there could be an issue in sourcing of ENA. So we are trying to do more of in-house manufacturing. But as I understand, this will be more of an industry-specific issue, not just for us. And obviously, we are a small player in the IMFL industry. We have much bigger players like United Spirits and Pernod, and we don't see them putting their own ENA capacity. So I'm just trying to understand what is different, whether that they will be able to manage with outsourcing, and we have to do own manufacturing. Can we also not have continued outsourcing and obviously keep our balance sheet more light instead of doing this high capex? So I just want to understand what am I missing here.
Yeah, that's an interesting question. If you see the history of Radico would be the only company to create close to about 10 to 15 premium brands in the last 1.5 decades. And this has been possible because of our quality, what we produce, and the spirit. We started as a distillation company, and producing the right quality spirit has been our forte. Even if you see Rampur Indian Single Malt, retailing at 8,500 rupees a bottle, much higher than any 18-year-old whiskey, and still being given on an allocation shows the quality we produce. So now we are seeing that it is the kind of premium portfolio, like even our 8 PM Premium Black, which has touched 2 lakh cases a month. Going forward with our Royal Ranthambore, Rampur, Jaisalmer, the in-house capacity of producing our own spirit is going to fuel my growth for the future. So, and even Magic Moment Vodka having a market share of 56% is itself, it speaks the quality of the liquor we produce. So I think by having this dual thing and the Sitapur, Radico has set its plan for the next 5 to 7 years. Secondly, if you see, we had waited for 5 years. My debt level from 950 is down to 130. Today we are going to get long-term, we are going to borrow only 370 crores long-term debt in the range of 6 to 6.5%, whereas these projects is going to yield me 20 to 23%. So I think it is the right time Radico is doing now once it has consolidated to position itself for the premium play for the next 5 to 7 years.
Okay, understood. I mean, just one point, sir, I want to make here is that, what we have done in last 4 or 5 years very phenomenal in terms of growth and improving our health of the balance sheet, which is also reflected in the stock price and our valuations. It's just that we have transitioned from a bulk alcohol manufacturer to a IMFL player. Now but we are again focusing back on bulk alcohol manufacturing instead of continuing to outsource like the bigger brands. So it's just that, and again you are taking that. So that's the concern here. I mean, if I was of the view that if bigger players can continue to outsource, why can't we do that and just focus on brand building, premiumization? I think that would have been better. That's would have been my view. Anyways, I take your point. And secondly, sir, on that ROC calculation, I just wanted to clarify. Is that obviously there will be some assumption of the grain-based ENA price there and the raw material, I'm assuming with mainly rice here. So what happens? I mean, I just want to clarify here. Is there a linkage between the ENA price and how's the linkage? I just want to understand. Suppose rice prices, hypothetically, rice prices go up. Does that significantly change our ROC calculation because our raw material price will go up and the grain-based ENA price? Is it linked to that? Because I think molasses-based ENA price is more governed by the government. The government tells what prices to sell at. So maybe the grain-based ENA price is also linked to that. And what happens if rice prices move? So how does it impact our ROC calculation?
See, we have done a ROC calculation on a very conservative basis in this project, because it is not only the alcohol, it will help me to sell the branded products where we have not even considered the margin. So there is enough headroom for the project. So the payback, I think, even after the pricing going up or down, would not affect it.
Okay, so you are saying the rice volatility in rice price, input price should not impact your payback periods?
Yeah, it should not impact much.
Okay, got it. Thank you. Thanks. That's it from my side.
Thank you. The next question is from the line of Avi Mehta from Macquarie. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, I just wanted to kind of continue with the last question a bit and more from a conceptual basis. What I hear is that you would like to do this capacity because it helps us grow in the premium segment. And hence, would it be right to assume that you would, as this growth continues, you would want to maintain that back-end support and hence want to have that capacity, and you may need to kind of add to this capacity, say, 5 years down the line or 3 years down the line. Is that the right way to understand that, sir?
See, that as of now to answer this question would be a little difficult, because if you see, we have planned for the next 5 to 7 years, like when we started Rampur Indian Single Malt or Jaisalmer being priced at 8,500 rupees and 3,700 rupees for Jaisalmer, the most expensive gin in the country. We did not expect the response to be so overwhelming. So depending on this, now with the capacity what we had invested 4 years back will start coming in 23, 24 of the malt. So depending on the demand, we will take our call during that time. But as of now, I think next 5 to 7 years, we are quite self-sufficient.
Malt for premium. Okay.
And this is going to greatly help in our premium portfolio.
And sir, as I hear you correctly, this is not a decision which has been based on the pricing of the ENA. You are not expecting ENA prices to rise further. It's just
no. It is for the grain, because number one, there are 2 points. We feel the molasses is going to get extinct. Second, the raw material, we get the grain of the best quality. We expand our gin distillery. We expand our maturation of malt for Rampur Indian Single Malt, where the volumes after 4 years can go much multifold, like what we did in our Rampur plant, which we'll see the volumes coming on 23, 24. So overall, I think from a premium point, and today when the debt is so low, 6.5%, and the projects can give us a ROC of 20 to 23% and help my premium portfolio. I think I think it will create a lot of value for all the stakeholders.
Okay, sir. And sir, the second question is, what you just on the grain versus molasses. Are you also arguing in a way that our regular portfolio at some point of time will also start using grain? Is that also the thought process behind saying that grain molasses will die and everything has to move to grain? Is that what you are?
See, absolutely, you are right. As it is today, 90% of our brands are using grain, and in the coming future, which is down the line, I think another 1 or 2 years, everything will be grain.
No, not for us. I mean for the industry. I'm sorry, I was not clear on that. I meant, are you arguing it for the industry, which is why you see capacity as being an issue? Is that what you were...
The industry also, if you see, gradually has moved towards the grain. Industry also, I think 70 to 80% will be grain now. So, but in the near future with this ethanol blending, I think next 2 to 3 years, everything is in grain.
See, what's happening is, as I had mentioned earlier, the growth in the alcohol branded business is only coming from the prestige and upward segments. That is the premium range. This segment is going to expand multifold in the next 5 years. And we will require that much more grain. Molasses will be extinct. And therefore, we are basically setting up this plant to make sure that we control our own grain spirit of quality, which has so far been a major factor in the success of Radico's portfolio.
Okay, sir. Okay. No, I mean, exactly. So I just wanted to clarify that the reason for this is quality and not a concern on availability or price. That is what I wanted to just clarify.
See, quality is definitely the prime focus, but obviously it will help us in price as well.
Okay. Okay, perfect, sir. That's all from my side. Thank you very much.
Thank you. The next question is from the line of Harit Kapoor from Investec. Please go ahead.
Yeah, hi, good afternoon. So I just had a few questions. One was on UP. So this whole, the change in the UP policy, has that been the core reason for the dual feed, or were you already thinking about this dual feed kind of capex? And just in addition to that, is there any incentives that the government is providing on this capex that you're doing on either on the Sitapur side, that adds to your ROC calculation?
See, if we have ordered the plant, we've been foreseeing this coming in the last one year, and now it has come sooner than later, which is very, very good for the industry of getting the non-IMFL business also into grain, because your recoveries increase, you are not dependent on any sugar mill, and your brands command that price. So I think that has been a very important and a good change which has come.
Right. And any incentives that the government is providing?
No, there is no incentive by the government.
Got it. The other question was on the 11 crore liters that come in fiscal year 24. So firstly, this 6 million that the 60 crore the 6 crore liters that you are outsourcing from outside, I'm assuming that all of it can't go in-house, right? Because you're buying from different states and the freight costs, etc. So how much of that can be now manufactured in-house for your own purpose out of the 6 crore liters?
See, this 6 crore liter is also increasing rapidly now, because what we are seeing with the volume ramping up and everything. So I think about 70-80% can be used for internal, plus the growth.
Plus the growth, and at the same time, this 42.8 which has been converted will also take a large chunk of that, which is again grain-based completely, which is 25% of the industry. So in the beginning, it will be a mix of our own for IMFL as well as non-IMFL, but at a later 2 to 3 years time, our own growth of IMFL business and the non-IMFL business will take away. So that capacity utilization we will ensure will be full by partly selling ENA outside as well as for our own consumption.
So Dilipji, 11 crore liters in FY24 that you are expecting to fully utilize, how much of that in your current calculation would be, say, selling outside, and how much of it would be in-house because of the country liquor being higher and also your own requirements on IMFL and the fact that you're not outsourcing anymore? And just an addition to that is, are you already now over next year going to kind of figure out the tie-ups with the brands for that 11, for selling ENA outside? How will that work?
So in the beginning year, couple of years, the capacity will also be utilized partly for supplying grain-based ethanol, where also there is a good pricing. So this is an interim for a couple of years, but eventually for IMFL and non-IMFL, it will, as the volumes are growing, it will make good. It will make good the complete this thing, and we have our plans where we have model where we've seen that for a couple of years only it will be supplied, and there also the realization and all that justifies this investment. And after that, with the grain, as we said, and that 25% has come into the non-IFL, eventually 36% and 25% will also get converted as the molasses availability is constrained toward ethanol blending. So keeping in view that mind, this is the first step, and the next steps the government has started taking will again be creating a huge demand for grain-based alcohol.
And just the last thing on this was, what is so out of this 550 odd crores that you are doing on the greenfield, how much is the land cost involved in this, roughly?
It is roughly 8% of the total project cost.
8% of the total project. Okay. Great. That's it for me. Thanks. I'll get back if I have more. Thank you.
Thank you. Next question is from the line of Jaydeep Walia from Newmark Capital. Please go ahead.
Sir, thanks for taking my question. So I wanted to find out if you would be manufacturing a different grade or quality of ENA in your new plant versus what is available in the market. My impression was that ENA is ENA, it's a commodity, so there's not much value proposition of creating your own distillery. So wanted to know your opinion on that.
The quality of ENA differ on the quality of plant, and being expert and running this plant for ages, so the quality of plant, the quality of alcohol being produced by our plant is much superior, and that is the reason we have been using all the alcohol of our own source in the magic flavors, Morphus, and all that. So to say that quality is for a commodity same is not right. At the same time, even we were exporting to the multinationals our quality of alcohol, which was not accepted from any other manufacturer. So to be actually control over our own quality in the branded business, it is a desired and necessary, compelling reason that we should have our own capacity expansion so that we can produce those kind of branded products which we are actually launching and in pipeline.
Just to add what Dilip's mentioned, when we used to export our ENA to global players, Radico ENA commanded a premium of 7 to 10% over all the other manufacturers, which is a testimony of the quality that we produce, and we intend to do the same thing in Sitapur plant as well.
Got it, sir. So the ROC number that you are projecting of, for the 20% kind of ROC on these new investments. So if I remember rightly, just 5-6 years back, on distillery plants, mid-single digit ROC was there. So the ROC might look good as of now because of, obviously there's a shortage of ENA because of the government blending program. But are you sure this kind of return on capital employed will remain after 3 years when all the capacity which is being created by the industry right now comes online? So it is possible that after 3 years, once all the capacity comes online, the return on capital employed might fall to low to mid-single digits.
See, the ROC what we have calculated, we have not taken into account the we are going to get because we are being able to produce more of our premium brands. So I think the ROC is also on quite a conservative basis. So I don't foresee going beyond going to a single digit at all. There's quite headroom for that.
Got it, sir. And sir, you could have looked at other kind of arrangements as well, right? Like co-locating your bottling plant with another distillery, capex for which would have been put up by some other party rather than Radico itself funding the capex. So have you explored those kind of arrangements, and what made you reject those kind of arrangements?
See, we would not like to risk our heart, which is our Rampur, Jaisalmer, all our premium products in anyone's else hand. This I am investing for the next 5 to 7 years, and especially where in next by FY25 we'll be debt free. So this is the investment for my premium portfolio and the growth of premium brands of Radico. which we would not like to risk it at any other people's this thing.
Got it, sir. Sir, isn't malt capacity expansion independent of distillery capacity expansion?
Yes. So we are also putting a malt maturation hall, which we had put it in Rampur about 3.5-4 years back, where our products will now start coming in 23-24, where the Rampur volumes will significantly go. So and even the gin, because the gin has taken off very well in the markets, and it is a craft gin, so a new craft gin distillery also will be put there.
Got it. Now, what I was trying to say is that you could have expanded malt capacity independent of this distillery investment, right?
Yeah, we could have, but again, going back to the same thing, we need to be 100% sure of the quality of the liquid of the alcohol that goes into our premium brands, and we will not take any chances on that. And when the returns are good, we are a debt-free company. Why not create more wealth and generate more revenue and more profits in years to come?
So to support it further, this is a business case. Business case to support the brand at the premium level. At the same time, it is a financial compelling reason as well. When we can raise the money at 6 to 6.25% for a 5-year period and can generate a ROC of 20 to 25%, then it makes sense to be having a secured raw material supplies, quality supply, generating revenue, generating the ROC, which is much better than what your cost of capital is. So this is creating in medium to longer term, the stakeholders value.
Got it, sir. Thank you. That's all from my side.
Thank you. The next question is from the line of Kaustubh Pawaskar from Sharekhan. Please go ahead.
Yeah, good afternoon, sir. Thanks for giving the opportunity. So this backward integration, what we are planning, with this, wouldn't it be fair that our margin trajectory, what you are targeting of around high teens, should improve?
See, especially with this backward integration and the premium brand, we want to give a guidance on a conservative basis where in a couple of years, we will be in the high teens. Then it all depends on your Rampurs and Jaisalmers where it can go further up, and Royal Ranthambore. But to give an estimate right now, we like to stick high teens easily.
Okay. And so you in your initial comment, you mentioned that exports is something, where there's some bit of disruption because of the lesser availability of container. And what kind of impact on the overall volumes was there in this quarter because of this lower exports?
You see, our export order book remains very healthy. Yes, there has been a global shortage of containers and the freight rates have been going very, very high. But the silver lining is that they've now kind of stabilized. And they're not increasing. Earlier, every fortnight the freight rates were going up and availability was an issue. So we do expect them to stabilize and hopefully in the coming months may come down, moderate a little bit, and the order, which are all in pipeline, will start moving out. Still, in terms of export, we grew by about 85% last year. And we are trying to maintain the same level of exports this year also, despite all the challenges. I think it will be a good way to consolidate our export business.
Right. And this quarter, even the regular, we have seen the volume growth a little bit on a lower side at around 2 to 3%. Last 2 quarters, we have been seeing at around 2 to 3%. Any specific reason for it, or should we expect it to remain at this level, or there should be further improvement?
See, what we see that the volumes are very buoyant for us in most states. In multiple states, our volumes are showing a double-digit growth. And that speaks a lot about the acceptance consumer franchise for the brands that we've cultivated over the last 5 years. So yes, we are very hopeful, we are optimistic, and we hope the trends to continue.
And we have guided earlier also that on the prestige and above category, we will be growing in double digit, more than double digit, and in the regular category where we are doing only in selected state, not of pan India, depending on the contribution it generates. So right there, we have always been talking about a single digit or 5 to 6%. So I think industry as well is also showing the trend that prestige and above category is growing better than the regular popular category.
Okay. Thank you.
Thank you. We take the last question due to paucity of time from the line of Deepak Lalwani from Unifi Capital. Please go ahead.
I just have a couple of questions. See, first, what is your current ENA requirement in UP market alone, and how much is being met internally?
UP market.
See, currently we are buying on an average about 20 lakh liters per month for the UP market. ENA.
Okay, so the point is, I understand that ENA is something which can't be, transported from one state to another state easily, right, given the taxation and all. So how are you planning to sell that, the extra ENA that you will generate from this capex?
One is the ENA what we are buying for the domestic market is about 50 lakh liters per month, and for the non-IMFL business we are buying about 20 lakh liters per month. So the 20 straight away gets utilized, plus the growth which will come, plus the growth of the premium brands, plus our shortage of even for the premium brands, the 50 lakh what we are buying, part of it will get converted into our own usage.
And a couple of years we will sell ethanol.
So, by which year, will you be in a position to use the complete new capex for your internal requirement?
I think that's the fourth year.
About 3 to 4 years.
Yes, 3 to 4.
So, the first 3 years you will be selling it to the other alcohol players. Is that right?
We will supply the grain ethanol in the meantime.
But do we have demand? I assume that there will already be enough supply in the UP market, right? Who are supplying?
Enough demand. I think supply gap, the demand supply gap, that the government itself is having, and very remunerative prices government is giving. And for that, government is also giving the policies like buying the grain from FCI and all that. That's to support the supplies. Last year, the supplies overall was 8.1%. This year, it has jumped by 300 basis points. I think the government talking about by 20% is a big target. And I think that will have if our own supply is there is enough demand, because 20% from 11% is a lot of gap.
That's foreign companies are buying from us.
Just one final question from my side. So, the capex that you are doing, for greenfield, which is